Oil at $100 a barrel sounds expensive. Oil at $40 a barrel sounds like a bargain. Drivers celebrate, airlines smile, fuel prices drop, inflation cools, and politicians take credit. It seems like everybody wins. But not exactly. For some countries, cheap oil isn't good news at all. In fact, for many oil-producing nations, falling oil prices can trigger economic crises, government budget shortfalls, rising unemployment, political instability, and even social unrest. The very thing consumers love, cheap gasoline, lower diesel prices, and affordable energy, can become a nightmare for countries whose economies depend heavily on crude oil exports. That's because oil isn't just another commodity. For many nations, oil is the economy. To understand why cheap oil can be so dangerous, we first need to understand how deeply the global oil market shapes the modern world. Every day, millions of barrels of crude oil move through a vast network of oil pipelines, oil tankers, refineries, shipping infrastructure, and international trade routes. Crude oil extracted from oil wells in Saudi Arabia may eventually end up in an oil refinery on another continent. Canadian crude imports flow through cross-border energy trade networks into the United States. Middle East oil powers industries thousands of miles away. The entire global crude trade operates through one interconnected system, and that system revolves around one thing: price. When oil prices are high, oil-producing nations generate enormous amounts of revenue. Governments collect taxes, state-owned energy companies earn profits, and investors pour billions into oil drilling, offshore drilling, onshore drilling, oil exploration, and energy infrastructure. The entire oil economy expands, new jobs are created, public spending increases, and economic growth accelerates. For countries that depend heavily on petroleum exports, high oil prices can feel like a financial miracle. But when international oil prices collapse, everything begins moving in the opposite direction. Global oil demand may weaken because of an economic slowdown. OPEC countries may increase production. New oil supply may flood the market. Geopolitical events can reshape global energy markets overnight. Whatever the cause, the result is often the same. Oil prices crash, and government revenues disappear almost instantly. Imagine running a household where half your income suddenly vanishes. That's what many oil-exporting countries experience during a major oil price collapse. The problem becomes even more severe because many oil-producing nations have built their entire economic model around fossil fuels. Instead of developing diverse industries, they rely on petroleum industry revenues to fund schools, hospitals, infrastructure projects, military spending, and social programs. Everything works well when oil prices are high, but when oil money dries up, there isn't always a backup plan. Economists often call this the resource dependence trap. Countries become wealthy from one valuable resource, but that same resource eventually becomes a source of vulnerability. History has shown this pattern repeatedly during major oil downturns, as countries heavily dependent on crude oil exports often face budget deficits, weakening currencies, declining investment, and slower economic growth. The same oil reserves that made them rich can suddenly create serious economic problems. Cheap oil may benefit consumers around the world, but for oil-exporting nations, it can quickly become an economic emergency. Cheap oil doesn't just hurt governments, it can also damage the oil industry itself. Many people assume oil production is always highly profitable, but that's not necessarily true. Some oil reserves are relatively cheap and easy to extract, while others require expensive drilling technology and large capital investments. A conventional oil field in the Middle East may produce oil at very low costs, but unconventional oil production is a completely different story. This is where the shale revolution becomes important. For decades, many experts believed American oil production was in long-term decline. The United States appeared increasingly dependent on crude oil imports, and energy independence seemed impossible. Then advances in drilling technology changed everything. Hydraulic fracturing, commonly known as fracking, combined with horizontal drilling and new oil extraction technology, unlocked massive shale resources across the country. The fracking revolution transformed the American oil industry and triggered one of the largest increases in domestic oil production in modern history. Shale formations, such as the Barnett Shale, became major sources of energy. US. Oil production surged, and America's shale boom reshaped global energy markets. The United States became one of the world's largest oil producers, dramatically increasing domestic energy supply and strengthening national energy security. However, there was a catch. Shale oil production is often more expensive than conventional oil production. Many shale producers require higher crude oil pricing to remain profitable. When oil prices are high, drilling expands rapidly. When oil prices collapse, investment disappears, oil wells shut down, and thousands of workers can lose their jobs. This highlights an important reality about the American energy sector. Producing more oil does not automatically mean earning more money. Profitability depends heavily on market prices. This is why discussions about energy security versus energy independence are often more complicated than they appear. Politicians frequently talk about increasing domestic oil production, expanding oil drilling, and achieving complete energy independence. But if oil prices remain too low, producers may have little financial incentive to drill more wells because the economics simply don't work. This challenge extends far beyond the United States. Oil-producing nations constantly balance supply and demand. Produce too little oil and prices may rise sharply. Produce too much and prices can collapse. This balancing act explains why OPEC influence remains so important in global energy markets. Major oil-exporting countries frequently adjust production levels to stabilize international oil prices. Their goal is not always to maximize production. Instead, they often seek to maximize revenue. Selling twice as much oil at half the price doesn't necessarily generate more income. In many cases, it generates less. Another hidden consequence of cheap oil is its impact on future production. When prices remain low for long periods, energy companies reduce spending. Oil exploration slows, refinery investment is delayed, and major energy infrastructure projects are cancelled. Companies postpone refinery upgrades and reduce investment in energy logistics and transportation networks. This creates a surprising paradox. Cheap oil today can contribute to supply shortages tomorrow. Less investment today often means less production capacity in the future. When demand eventually recovers, prices can rise dramatically, creating another cycle of boom and bust. This boom and bust cycle has defined the global oil market for decades. Yet, perhaps the biggest challenge facing oil-producing nations today isn't low prices, it's uncertainty. Oil-exporting countries worry about declining revenues. The world is simultaneously moving toward a clean energy transition. Renewable energy continues expanding. Solar power becomes more affordable each year. Wind energy grows rapidly. Nuclear energy is receiving renewed attention. Governments are investing heavily in alternative fuels and developing long-term energy transition strategies. Concerns about climate change, greenhouse gas emissions, carbon emissions, and decarbonization continue shaping environmental policy around the world. For countries heavily dependent on fossil fuel revenues, this creates a difficult question. What happens if global oil demand eventually stops growing? What happens if the future of fossil fuels looks very different from the past? Some nations are responding by investing in energy diversification, renewable electricity, and sustainable power generation. Others are moving more slowly. But cheap oil serves as a powerful reminder that relying on a single resource has always been risky. The story of oil is not just about gasoline production, diesel production, refinery economics, or global oil trade. It's a story about risk, dependence, and national energy security. It demonstrates how a single commodity can shape the destiny of entire nations. The next time you see fuel prices falling and hear people celebrating cheap oil, remember that what feels like a gift to consumers can feel like a warning sign to oil-producing countries. When an economy depends on crude oil exports, every drop in oil prices echoes through government budgets, jobs, investment infrastructure, and long-term economic stability. And that's the strange reality of the global oil market. The thing buyers want most is often exactly what producers fear. If you enjoyed this deep dive into energy economics, oil geopolitics, OPEC and oil markets, the shale revolution, and the future of global energy security, don't forget to like the video, subscribe to the channel, and turn on notifications for more stories about how the world really works beneath the surface.